Hello, everyone. Welcome back. I'm Ruben Torrens, and today I'm going to tell you about what happens when you make an RRSP contribution and what happens also when you have to take money out of that either RRSP because you have an emergency and you need to dig into your retirement savings or from your RIF, RRIF, when you are at retirement, which is pretty much the same thing because I'm not going to be talking much about tax credits, which will be the only difference. When you deposit money into RRSPs, I can guarantee you this is for sure. What happens is that your financial advisor slash financial institution makes money. Yep, they make a commission on your money, and probably this is not guaranteed. If the planets align properly and we have another sort of eclipse like yesterday, you're gonna make money too. So the worst part of all this is that I'm not joking. This is serious. So let me show you in numbers what I'm trying to say, because we need to go first into taxation and then into retirement. So just let me take you to a small short presentation that I prepared for you to show you to highlight what I'm saying. When we make contributions to RRSPs, it is important to know how much we save when we make the contribution and how much we will have to pay when we get that money back. And to do that, what we're going to do is we're going to review how much we save in the contributions, how the tax base work, how much we paid on the withdrawals, regarding again CRA, the Canada Revenue Agency, how much tax we pay to the CRA, but also we're going to take a look after that at the pension reduction, the potential pension reduction and withdrawals from Service Canada, which is the other agency from the government. So there, when we take money out of RRSPs, two things can happen, and we're going to take a look of that. So, but first, let's take a look at how we're taxed in Canada. So in Canada, we have a progressive tax system, meaning the more money we make, the more tax we pay. For example, on the first $50,000, the combined rate between the provincial rate and federal rate will be, for this example, 20%. So for the segment from, if you earn more than $50,000, from 50,000 to 80,000, we're going to use 25% for our example. From 80,000 to 100,000, for this 20,000, we're going to use 30%. And for the next 20,000, from 100 to 120,000, 40%. And from 120 to 140,000, 50%. This is for the purpose of this example. These are not real tax rates. Real tax rates change by province or territory. For example, here are the rates for Alberta plus the federal tax rates combined on the first $55,867, 25%. These are real tax rates for 2024, 55,867 to 111,733, 30.5%. But it's very difficult to give example and very confusing to form examples using the real rates. And it makes no sense because it changes depending on the province. This is for the province of Alberta, but every province and every territory has different tax rates. So for the purpose of the illustration, I'm going to use these tax rates. So the ones that I created, which is a lot easier to handle, just to give you the example. And then we're going to take a look at what happens if you earn, say, $50,000 in a given year, and you can make an RRSP withdrawal or take money out of an RSP. We're going to look at both situations. On the first example, it's going to be neutral. It's going to be only $50,000 of income, so the total income will be 50,000, and the tax for 50,000, well, from 0 to 50,000, we say that is 20%, so it's $10,000. So here we have $10,000. Now, of course, you might be wondering, say many people say, well, in the first $15,000 or so, we don't pay any income tax. It's not that. It doesn't work that way. In the way it works is that you have a tax credit which is equal to the minimum tax rate that you pay on $15,000 or about $15,000. So the lowest tax rate is 20%. If we calculate 20% out of $15,000, the tax credit becomes $3,000. So the tax credit, what it does, it reduces your tax payable. So we have now $10,000 of tax payable, but you have $3,000 of this particular tax credit, which is the basic personal exemption. So you end up paying only $7,000 in tax. You may have other tax credits. Here, I'm using only one example, which is the one that we all have, which is the basic personal exemption. Now let's take a look at the same scenario. What would it happen if you earn the same $50,000, but you contribute $10,000 to RRSPs? So what happens is RRSPs, opposed to a tax credit, is a deduction, an income deduction. So from the 50,000, we deduct 10,000, and we end up with $40,000 of total income, taxable income. So the is again, in this bracket, 20% of 40,000 is $8,000. You have the same tax credit, the same $3,000. So therefore, you end up paying $5,000 in income tax. What happens here? What do we have here? Now, the $10,000 of RRSPs make you save from 7,000 to 5,000, $2,000 in tax, or 20% of the $10,000, which is your tax rate. That's how it works. Now let's take a look at what happens if you have a bad year and instead of depositing $10,000 in RRSPs, you have an emergency and you need to withdraw $10,000 from your RRSP. You earn the same $50,000. Now we have to add $10,000 of income. Now you have an extra $10,000 of income. So your total income is $60,000. Now we have a problem here because now you have $50,000, which is at the lowest tax rate, but another 10,000, which is exceeds the 50,000, gets into this tax break. That 10,000 gets taxed at 25%. So you have $10,000 for the first 50,000 and another 2,500 for the other $10,000. So 12,500. And now you have the same tax credit, of course, because the basic personal exemption continues to be the same, and your tax payable is $9,500. So when we deposit in this case, in this scenario, the $10,000 in RRSPs, you save $2,000 in tax. But because withdrawing money from RRSP got you into the next tax rate, into the next tax bracket, now it's costing you to withdraw that 2,500 from 7,000 to 9,500. And the same thing will happen if your income is higher. And here I give an example of $90,000 of income. So that will be that the first $50,000 are taxed at 20% or $10,000. The next $30,000 up to 80,000 will be taxed at 25% or 7,500. So far we have 17,500. But then you need to get to 90,000. So another 10,000 will be taxed at a 30% tax rate, so $3,000. So the total tax liability will be 20,500. Once again, we have the basic personal exemption for 3,000, so the tax payable will be 17,500. And again, if you are in this situation, and you contribute $10,000 to RRSPs, it will make that exact same impact. So will reduce your income to $80,000. So for $80,000, now you have 17,500 tax payable or tax liability because you have 10,000 for the first 50,000 and 7,500 for the next 30,000 to complete the $80,000. So 17,500 less than the $3,000 basic personal exemption, you end up with a tax payable of 14,500. So what happens here? The $10,000 falls into the 30% tax bracket. The whole 10,000 falls into that tax bracket. So the tax liability gets reduced from 17,500 to 14,500. So now the $10,000 deposited in an RSP it saves you $3,000 in taxes, or 30% of the 10,000. Once again, it's the same scenario. If you earn $90,000 and you take out $10,000 from your RRSP, now you have $100,000 of income. So that will be $23,500 in taxes because it's the 10,000 plus the 7,500. That to complete 80,000 plus another $20,000 at 30%, which is another 6,000. So we end up at 23,500, less than still getting the basic personal exemption. The total tax liability will be $20,500. But this is at the CRA level. This is what happens while we are working and we're contributing to our RSPs, or we sometimes we have an emergency and we need to dig into our retirement savings. What would happen when we retire? What would happen after age 65? Because after age 65, everything changes. For example, in these cases, after age 65, the tax credit is no longer going to be $3,000. It's going to be a lot larger because you will have the pension credit and you will have also the age amount, the age tax credit. So that's going to be an advantage to you. But there is also a disadvantage. And this is what I want to show you. In order to show you this, I need to go to my website and to use the pension calculators. And here we are at pensionbooster.ca. Don't worry about the link. I will include the link for my website into the description of the video so you can go in and run your own calculations. We're going to go to the pension calculator, and as you a single person with 40 years of Canadian residency. If you have never seen this, just go to the homepage, and where I explain how to use these calculators. So we will assume that we have a person retiring with 40 years of Canadian residency, receive $713 per month of all-day security. By the way, this has been updated to April till the period of April till June 2024 is the same rates as January till March of 2024. The Service Canada has announced that there was no change on the consumer price index, so the all-day security hasn't increased for this period, so it remains the same numbers. Uh, this will receive $713 per month of all-day security, and let's assume that it has about $900 per month of Canada pension plan. It has above average Canada pension plan. We calculate this. Doesn't have an employer pension, and it save say about 180,000, $200,000 in RRSPs, and this is what it has. And it wants to be conservative and match the same withdrawal that he had from Canada Pension Plan as withdrawals from RRSPs. So he will take another $900 every month from RRSPs, from his RRSPs. Now, here is what happens. When we recalculate this, you notice that it has $713 per month of all-day security, $900 per month of Canada Pension Plan, $450 per month of guaranteed income supplement, for a total of $2,063 from the government of Canada. So these are government pensions. Now, this person does not have an employer pension and will withdraw $900 per month from his RRSPs, or his or her RRSPs. So this is what happened. That $900 per month, when we recalculate, will reduce the guaranteed income supplement basically into nothing by $450. What this means is that if this individual continue to do this for the rest of his or her life, withdrawing this $900 per month because it saved he, $180,000, $200,000 in RRSPs, all the money, all the time that comes from RRSPs, so 50% of that money will be lost in guaranteed income supplement. This is like paying 50% tax. This is something that you want to avoid at all costs. You don't want to do this because this is terribly expensive. If this is your situation, RRSPs are clearly not for you. Like even if you get double that amount, even if you get up to $1,800 per month, So you will still losing the $450. That's a 25% tax that you're paying on your money. So you need to meet with your financial advisor and find another strategy, a strategy very different than RRSPs. Now, let's say that this is not your situation. The situation is such that you have an employer pension, a very solid employer pension, and you receive, say, $6,000 per month of your employer pension. You're a government employee, you're a teacher, you're a police officer, you're someone that has a defined benefit pension, a solid defined benefit pension, and you have all this amount. Well, then eventually you don't worry anymore about the guaranteed income supplement. But it becomes another worry because when we calculate this, we notice that the all-day security start coming down. And if you will receive, say, $6,000 of your employer pension plus your Canada pension plan, and your all-day security start coming down, well, then if we add, let's say, another $1,000 coming from our RSP, let's see what happens. We are going to add, instead of 6,000, we are going to add this employer pension plus $1,000 coming from our RSP. That will be $7,000 in total. And then when we recalculate, we'll see that the $950 becomes becomes 550. So it reduces by $150. It reduces by 15% the all-day security, 15% of the money that this individual is getting out of his or her RRSP or RIF. Now, many people tells me, but Ruben, like at that income level, I don't mind losing the all-day security is only a 15%. But when you think that you're paying minimum 30% tax, your marginal tax rate is already at 30%, and you add another 15%, now it's costing you 45% tax, and probably you don't want to pay for it. You don't feel very comfortable by paying 45% or 50% tax on your money, on your RRSP withdrawals, because you never saved that money to begin with when you deposited, when you contributed to RRSPs. This is why you need to sit with your financial advisor to find an alternative to RRSPs, an alternative investment. And there are alternative investment, guys. There are Series T mutual funds that they're tax-oriented mutual funds. There are return of capital funds that you can sit down with your financial advisor, and the financial advisor can guide you and understand your situation. And if your financial advisor cannot understand this situation, well, it's time to look for another financial advisor. After all, that person is working for you, and if your employee is not doing the right job, it's time to fire that employee and hire a new one. So that is the situation. If your income is going to be low at retirement, then you have to worry about the guaranteed income supplement. Like 10 years before retirement, you should already take a look of what's your retirement income is going to come from, where is it going to come from, and if you're bound to be eligible to receive guaranteed income supplement, or if you're bound to have your all-day security clawback. In one of those two situations, so then you have to doubt your RRSP. Probably RRSP is not the best idea for you. And if you're not, if you're in the middle, if you're not, if your income is not low enough to qualify for the guaranteed income supplement, and it's not high enough in order to have your all-day security clawback, that means that the planets align in the same in the way you need to align, and you may have another eclipse, solar eclipse like yesterday, and RRSP is for you, and it's a good deal. So a few of us are in that situation. I am one of them. RRSP is a good thing for me, and a few of us are in that situation. But a lot of people is not. A lot of people is either at one end or or the other, and you have to be really careful. I hope you enjoyed the video. I hope I didn't confuse you too much. Make sure that you subscribe to the channel. You don't want to miss what is coming. And give me a like, guys, if you can. That will help me a lot. And on the description of the video, just below the video in the descriptions, there's going to be my contact information and the website that I use for the calculators. Those calculators are free of charge. You can just register on the website with your email address and your postal code, and they're free for you to use. Thank you again. Thank you for your time, and I'll see you in the next video.